Have you ever wondered how massive companies make those huge bet-the-farm decisions? We're talking about building a new billion-dollar factory, launching a product that could change everything, or even buying another company. You know, these aren't just gut feelings. They're calculated risks, choices that can literally define a company's future for decades.
So really, how do they do it? How do they look at a dozen different opportunities and figure out which one is the real winner, the one that's actually going to create value? Well, the answer lies in a really disciplined process called capital budgeting.
And at its heart, capital budgeting is just that, a framework. It's the formal, structured way companies evaluate these massive projects to make that final, crucial call. Is this a yes, something we pour our money and energy into, or is it a no, an opportunity we have to let go?
So here's what we're going to do. We're going to build out your financial decision-making toolbox piece by piece. First, we'll talk about why these decisions are such a big deal. Then, we'll look at a really simple starting tool. After that, we dive into the heavy hitters, NPV and IRR, and figure out why they sometimes fight with each other. We'll add one more specialist tool for ranking projects, and then we'll bring it all together.
Okay, so what really separates a decision about a billion-dollar factory from, ordering new staplers for the office? Well, according to the Institute of Chartered Accountants of India, the ICAI, these massive investments are just in a completely different league for a few really critical reasons.
First, the amount of money involved is just huge. Second, the impact lasts forever. These choices shape the company for years, maybe even decades. Third, a lot of the time, they're irreversible. I mean, you can't exactly return a half-built factory. And finally, they're incredibly complex because you're forced to make a huge bet on a very uncertain future. The stakes just don't get any higher.
So with all that complexity, it's pretty natural to want a simple tool to get started. And the most intuitive one in the entire toolbox is the payback period. It asks a very, very simple question. How fast do I get my money back?
As folks from both the ICAI and India's Shobit University explain it, the payback period is just that, the time it takes for a project's earnings to pay back the initial investment. It's all about speed. Check out this simple example. A project cost 50,000 rupees upfront, and it brings in 12,500 rupees every year. The math couldn't be easier, right? 50,000 divided by 12,500. That gives you a payback period of exactly 4 years. It's fast, it's easy, and it makes intuitive sense. But you knew there was a but coming, right? That simplicity is also its biggest weakness. The payback period completely ignores one of the most fundamental ideas in all of finance, the time value of money. The simple fact that a rupee today is worth more than a rupee tomorrow. It also totally ignores any money made after you get your initial investment back. So a project could turn into a cash printing machine in year 5, but the payback method wouldn't care one bit. So to get past those really big flaws, we need to bring out the big guns. Let's move on to the two most powerful methods in capital budgeting, the ones that do account for the time value of money. Net present value, or NPV, and the internal rate of return, or IRR. NPV asks a really powerful question. After you account for all the costs and the time value of money, how much total wealth, in today's money, will this project create? It gives you one single powerful number, the absolute value, in dollars or rupees, that this project adds to the company's bottom line. And this is how it works. The formula basically acts like a time machine for money. It takes all the cash you expect to make in the future and pulls it back or discounts it to figure out what it's worth right now, today. Then you subtract your initial investment, and what's left over is the net present value. If it's positive, you're creating value. Simple as that. Now let's switch gears to IRR. It asks a different kind of question. It asks, what's the project's built-in rate of return? You can think of it like the project's own personal interest rate or its annual growth rate. It's the one special discount rate where the NPV of a project would be exactly 0. So here's the key difference, right? NPV gives you an answer in hard currency, the actual wealth you're creating. IRR gives you a percentage. For NPV, the rule is easy. If it's greater than 0, go for it. For IRR, you only accept if the project's percentage return is higher than your cost of capital, which is just the minimum return your company needs to make. And this subtle difference is why they can sometimes give you conflicting advice.
And that brings us to the main event. What happens when these two powerful tools disagree? When one says go and the other says stop, or they rank two great projects in a different order. This is where we have to pull back the curtain and look at IRR's hidden flaws.
So the first big problem, and this is something researchers at Carnegie Mellon pointed out years ago, is the issue of multiple IRRs. If a project has what we call unconventional cash flows, think of it as money going out,
then coming in, then going out again, the math can break down and give you more than one answer.
This chart shows you exactly how that happens. You see the cash flow starts negative with the investment. It turns positive as you make money, but then it goes negative again, maybe for a cleanup cost at the end of the project. That pattern of flipping signs can totally confuse the IRR math. It might spit out 2, 3, or even more possible returns. So which one is right? Well, none of them. The number becomes totally useless.
But there's a second, and honestly, a much bigger flaw. It's this tricky little assumption IRR makes under the hood. It assumes that all the money the project throws off can be reinvested at that same super high IRR. NPV, on the other hand, makes a much more realistic assumption that you'll reinvest the cash at your company's normal cost of capital. That's a way safer bet.
So what's the final verdict from pretty much all of finance theory? It's really clear. When NPV and IRR get into a fight, you listen to NPV. Every single time. Why? Because NPV directly answers the single most important question a company has. How much actual, real-world wealth is this project going to create for us? It is the gold standard.
Okay, but our toolbox isn't quite full yet. There is one more specialist tool we need. It's for a really common problem in the real world. What do you do when you have a bunch of great projects, but not enough cash to fund all of them? This is called capital rationing, and for that, we use something called the Profitability Index, or PI. The Profitability Index is basically a bang-for-your-buck ratio. The calculation is super straightforward. First, you figure out the present value of all your future cash flows. You already did that for NPV. Then, you just divide that number by your initial investment. That's it. Let's see how this works. Say a company's looking at a project where the present value of all the future money is 13 crore rupees, and it costs 10 crore to get it started. You divide 13 by 10, and you get a profitability index of 1.3. What that actually means is for every single rupee you invest, you're getting 1.3 rupees back in today's value. Anything over 1 is a good project.
Okay, so we have covered a ton of ground here. We've gone from a really simple but kind of flawed tool all the way to the industry's gold standard and even a special ratio for ranking. So let's put this all together and take one last look at our modern financial toolbox.
This table is pretty much the ultimate cheat sheet. You've got payback, which is simple and all about speed, but it's got major flaws. There's IRR, which gives you that nice intuitive percentage, but it can be really misleading. You've got the profitability index, which is perfect for ranking projects when you're short on cash, and then there's NPV. It directly measures the absolute wealth you create, and that's why it remains the #1 most reliable tool for making that final yes or no call. But all of this leaves us with one last, really fascinating puzzle, doesn't it? If the academics are so unified that NPV is king, why do surveys of real-world CFOs consistently show that they still love the simple appeal of IRR and the quick and dirty answer from the payback period? It's just a great reminder that big money finance isn't only about spreadsheets and formulas. It's also about human psychology, intuition, and telling a story that people can understand.